I'm Greg Hunter. Welcome to USAWatchdog.com. Listen, no matter who is finally seated in the White House with all the chaos, what we have are some serious problems for no matter who is going to be in the White House. I hope a lot of people hope it's Donald Trump that he'll, pull a rabbit out of his hat. He may. But anyway, no matter what, we still have lots of problems, lots of money printing. The 10-year Treasury was 0.6 something percent for the longest time. Now it's almost double that. It's 1.15%. You think, well, 0.6% to 1.15%, that's not that really much more. Percentage wise, it's almost double. Gold had a fantastic year. Silver had a better year. Jim Rickard said silver was the best performing asset of 2020. Is that going to continue? And the person who was correct last year came on and gave his yearly look forward and said, "Hey, we're going to stop out at about $1,800 an ounce for gold." Wow, it was 1901 for the end of the year. That's Craig Hemke, TF Metals Report, market analyst extraordinaire, specializing in precious metals, but does all the markets. Craig Hemke, thank you for joining us today on USAWatchdog.com.
Always good to see you, my friend. Happy New Year.
Happy New Year to you. You know, you famously have said, I've said this multiple times, but I just love the quote, is that, you got to be careful when you're, doing forecasting because you can only predict the end of the world one time. And so, you really try to, hit it right. You got within $100 of the gold price and it went up, 25%. So pretty good. I mean, fantastic, close enough. What's going on with the 10-year Treasury effectively doubling basically to 1.15%? And you're seeing gold kind of back off. We had some rough days this last week where we're down as much as $70 in a single day or 75, something like that. It came back up. What's going on with the interest rates in gold?
Well, I'm glad you wanted to start there, Greg, because in my annual forecast that I just published last week, one of the key themes was don't fight the Fed. If you've been a stock market investor or, for any length of time, I'm sure you've heard that term used before. And it works for the precious metals this year as well. The Fed will take some significant actions over the course of this year, and that will drive gold and silver higher, gold to new all-time highs again at some point, and silver is going to participate too. And it's this change in Fed policy that really first kicked in at the end of 2018 that allowed us to kind of go out on a limb in January of 19 and predict, kind of lonesomely actually, and precariously sitting out at the end of this limb, predict that gold was going to break out of its 6-year range and go to 1520. And that's actually almost exactly where we finished the year 2019. I figured this would continue, this final shift in Fed policy would continue last year, even before anybody ever heard of COVID. And that's exactly what happened. I had a target of 1,800. We overshot that, but finished at 19. And, it's going to be some rough sledding from time to time. And a bull market, just like riding a bull at a rodeo, is going to try to buck you off every chance it gets. But I think if people understand the macro component, understand how all these pieces fit together, you'll see why you should expect more highs this year. And I think that's where we're going.
Well, why more highs? What it's some people look at the budget, what they were doing with the what do you call it, the federal budget. I mean, they're just they 900 billion was supposed to be some conservative thing.
Yeah. Yeah.
I mean, after a couple of trillions of dollars, I mean, you just blew it out. But then you have Martin Armstrong on the other side saying, "Yeah, they're printing a lot of money, but you got all these, all this capital destruction, all these businesses going out of business and layoffs, and commercial real estate." Tell me what's going on with the yin and yang of the debt that's gonna get paid by somebody, I guess, and then on the other side you have all this money printing.
Right, it's going to get paid by somebody, and that somebody is going to be the Fed. And they are already monetizing almost all the current Treasury issuance. We know, when the Biden administration takes over, you got a whole, full control of Congress by Democrats. So they're going to blow spending out through the roof. In fact, and Chairman Powell at the Fed is begging for that to happen. He stated several times the last few months about how he'd love to have an increased fiscal policy, more deficit spending, so the Fed can monetize it, print more cash, and get it shoved out into the economy. Because what they are worried about is what you mentioned, disinflation or deflation. The monetary system in the U.S., the way it's structured, actually the whole world, cannot allow disinflation or deflation. That's why they're always talking about sparking inflation, spurring inflation. In fact, Powell is even worried just about inflationary expectations. And that's why he made some significant speeches last year, kind of laying out where the Fed is going to go. So again, getting back to don't fight the Fed, yeah, there are all these moving pieces, but yet the Fed is going to do everything they can to spark inflation, but then also hold down and restrain long-term interest rates, everything from maybe 5 years out to 30. They're going to do everything they can. They've got tools for doing that. They have done that in the past as a historical guide. The last time we had debt to GDP at this ratio was right out of World War II. And back then what the Fed did was they instituted something called yield curve control, where they put a cap on interest rates, meaning that anytime interest rates moved up, they were aggressive buyers of treasury bonds and drove the rates back down. But in doing so, they created sharply negative real or inflation adjusted interest rates, and it allowed them to kind of inflate away the existing debt. Okay, you're paying it off, the old debt, with less valuable current currency and future currency. That's what they're going to do. Again, they admitted last year that they are studying it, that they understand the value of that, and that's the direction they're going to head. That will become clear as this year goes on, and that institutionalization of sharply negative real or inflation-adjusted interest rates is what's going to drive gold and silver to another big year.
I had Rickards on. You and him are kind of saying the same thing, although it sounds a little different. But he basically said they can't let rates rise. Bill Holter, I just had him. He says, they cannot let rates rise. I mean, yes, I know rates were. I think I interviewed him. It just had crossed 1%, which is like 1%, but still,
yeah,
it's a big percentage move from where it is. But you're saying they're gonna open a can of whoop ass on interest on the 10-year yield. Is that what you're telling me?
Yeah, what it'll do is it'll just crush anybody who's bearish on bonds, expecting prices of bonds to fall and interest rates to rise, because the Fed will basically come in with like a backstop. People might have heard the Fed put for the stock market before, where people say, they're not going to let it go down, so you buy the dip all the time. If there's a Fed call, if you will, on bonds saying, hey, every time it goes above a certain level, we're a buyer, then sometimes it doesn't even have to go to that level or beyond it, because the market, the rest of the market, the buyers will go, well, wait a second, we're not going to go in here and short bonds or let rates go any higher, because the Fed is right there waiting to drive rates back down. And that's what they'll do. Excuse me, I itch my eyes. So again, drawing this back to why we've been so accurate for the last couple of years. At the end of 2018, the Fed had been on this course for 5 years, spinning this lie that they were going to normalize their balance sheet, which meant they were going to go back down to $1 trillion where they were in 2008. What's it now? 5 trillion? I mean, that was never going to happen. Never. And they also kept saying they were going to normalize interest rates, like for people, that want to, retirees that want to live off of CDs, like they were going to go back to 7%. That was never going to happen either. I mean, we have so much accumulated debt, not just public, but private, that the economy will absolutely collapse, and it is so deflationary if interest rates start going up. In November of 2018, Greg, the 10-year Treasury got to about 3.25%, and that was finally the breaking point. Stock market collapsed about 20% in December of 2018. And the problem with that higher rates is, and this is where Rickards and Holter are coming from. I mean, now the market can trade a little bit of higher rate in the interim, but across the board, the U.S. economy cannot afford higher rates, whether it's the servicing of the existing debt, the line item interest on the national debt, and how quickly that grows the ongoing deficit, right? That begins to exponentially go out of control. Or there's just private debt. The people that barely even have $1,000 in savings can't have their credit card rates go over 20%, or auto rates go back over 6 or 7%, or our mortgage rates go to 4 or 5%. It just can't. And so when we talk about the Fed can't allow higher rates, it's not that the Treasury, the yield on the 10-year Treasury can't go from 1 to 115. What they can't afford is have it go to 2 or 3. Okay, so what's going to happen Here's the first thing that people, let's put it this way. Here's the first thing people should watch for as this year goes along. The next FOMC meeting for the Fed is in basically 2 weeks, okay, last week of January. Coming out of December, there was already talk about amending their existing quantitative easing program. Remember, they're buying about $80 billion in treasuries every month. That's $1 trillion a year. And about $40 billion in mortgage-backed securities, which is how they're keeping mortgage rates low, okay? That's $120 billion a month. But they're mainly focusing on the treasury side of that equation. They're on treasury bills, which are things that have a maturity of less than a year, and treasury notes with maturities less than 5 years, okay? So they're keeping the short end down. There was talk in December of amending that and starting to buy some of the stuff on the longer end, 7 years, 10 years, 20 years, even 30 years. The first step toward this yield curve control policy, which is coming this year, will be notice from the Fed. And maybe in January they'll say, yeah, the participants were starting to think maybe amending, and taking a look at buying longer maturities. If that doesn't stop rates from rising, as you said, we've gone from 60 to 115 basis points on the 10-year Treasury, from 0.6 to 1.15%. If that doesn't stop rates from rising, maybe by March, they'll come out and say, oh, we're definitely doing this. We're going to start buying. And then that extra demand, that buying, stops rates from rising. If that doesn't do it, then by the middle of the year or whatever, they'll come out and formalize a policy like they did in 1945 that says we will not allow the 10-year Treasury to trade above, I don't know, you name it, 1.5%, 1%. And if it ever does, we're going to be aggressive buyers of Treasuries to push it back down. And at that point, that rate is capped. But the problem is all this money printing and what they need to inspire comes from it, and that's inflation. So if they're going to cap rates at, say, again, 1.5% for the 10-year Treasury note, and then inflation goes to 3.5%, then your actual inflation-adjusted return is negative 2%. Well, holy smokes. The 10-year Treasury note is basically the investment foundation of the current system, okay? It is the cornerstone of institutional portfolios around the world. And if you're locking in and guaranteeing a negative return on your money, then all of a sudden other items look pretty good. One of those other items as an investment is gold. And that's how all these pieces kind of fit together. So we'll watch for these changes from the Fed as we go through this year. The only thing I don't know is how soon we head down that road, but it may be as soon as later this month.
Well, there are people out there going, well, we don't have 2 or 3%. We're talking about Fed numbers, just talking about their world that, we have, less than 2% inflation. Other people have come on here. Catherine Austin Fitz, for one, if it said, depending on what metrics you look, John Williams, it says, the real inflation rate is somewhere in the 10% range. Catherine Austin Fitz says, well, in Tennessee, and it's probably 8%. In the Silicon Valley, it's probably 14%. Of course, got a lot of businesses going out of business and a lot of deflation and a lot of debt destruction and all that going on. What's the Fed? What can the Fed do about that? I mean, we got all these commercial real estate prices, bonds, and everybody's down. Bill Holter said they're not down 90 days; they're down 300 days. They haven't made a payment. These people are going to tank. Now Cuomo is saying, let's open it back up. Of course, he thinks Biden's going to be in. Maybe he is. Maybe he's not. But he knows he's destroying the economy. They're just, keep voting Democrat while they destroy your world. But what about all this commercial real estate debt? Talk about that.
Oh, yeah, no doubt. I mean, this is all long-lasting, permanent impact of COVID. Even if you use the government labor statistics, the jobs market, which, hey, look, it's bouncing back and all that kind of, yeah, that's great. But we're still down about 12 million jobs from March, using the BLS's own statistics, okay? You got businesses closing everywhere, still going out of business that aren't coming back. Other segments, like you said, commercial mortgage market is going to be decimated because even as the economy improves, companies now are looking around going, wait a second, why are we paying for all this office space? We got along just fine with everybody working on. We can at least cut it back in half. That works for the company. It doesn't work for the owner of the building, right? I've got a couple of friends of mine that traveled globally for their jobs, right? Constantly going here and there. In the end, they've adjusted just fine. Yeah, you still want to go see your clients every now and then. But you don't need to see them once a month. And so the travel industry, the airline industry, the hotel, all these things are going to be impacted. All the workers that service those industries are going to be impacted. So we're not bouncing back, and, all of a sudden V-shaped, everything's just right where it was, pre-COVID anytime soon. But yet you've got the Fed having to monetize all this debt, address all these problems. That's why you've heard Chairman Powell say, we're not raising the Fed funds rate, which is the overnight rate, which is the only rate they actually control. We're not raising that rate through 2023. That's at least 3 more years. And that's all these different myriad reasons that I just mentioned are why they can't and they won't. But the problem is they cannot allow, as inflation picks up from all this money printing and we get into stagflation, they can't allow the 10-year Treasury to go to 3% again either, because that's deflationary, and they're trying to fight that as much as they can. So they will at some point institute yield curve control. In fact, I'll give you one more thing, a hint that we know this is coming besides the fact they've done this in the past. Back in late August, Chairman Powell at the Fed's virtual Jackson Hole meeting announced a pretty significant change to their inflation policy going forward, where they said, we're going to allow it, used to be if we got to 2%, you could count on us, raising the Fed funds rate, but now we're going to go well past that. That was kind of trial ballooned. I think a lot of people know what that means. You put an article on Bloomberg or the Wall Street Journal, late on a Friday, and you kind of see what the response is, without anybody really noticing. Well, trial balloons of this policy change were floated in July. And that inflation expectation thing that Powell then announced in August was just one part of the balloon. The other part, all of those articles said the second part of this program will be formalized yield curve control. Now, whether that's done, again, just through existing QE programs and buying 10-year notes instead of 1-year bills, or if they actually have to come out and say it, that's what's coming. Last thing to inflation, because this speaks to the markets and just where we are in these days. I mean, the global markets are almost totally controlled by computer, right? And by these massive institutions, whether hedge funds, pension funds, central banks, okay? You and I know what inflation is. A lot of your listeners will know what the Chapwood Index is, where you can go on and see what the actual cost of living and how much it's rising city by city. I mean, we all know it's not 2% it's ridiculous. Go to the grocery store, gasoline, your rent, all this, your home price, all that stuff. But that doesn't matter. And why doesn't it matter? It's because the way these markets are structured and the way they're traded. All these computer programs run off of that stated CPI, all of the cost of living adjustments for Social Security recipients, all that stuff. They run off the stated CPI. So you and I can talk about how that's nonsense, how the CPI deliberately understates inflation, and it does. And we can talk about how the real cost of living is 10%. But that doesn't factor into the investment decisions of whether to buy bonds, whether to buy gold, all this kind of stuff. What factors in is the CPI, that printed CPI. And that is just now starting to move toward 2. It is that will go toward 3 and maybe even beyond. And when you lock in nominal yields, the actual stated interest rate on a 10-year Treasury at, like I said, 1 or 1.5, then your inflation adjusted return is negative 1 or 2%. And that's, again, on a base level, that is where gold and silver become really attractive looking investments as an alternative. And there's a distinct correlation over the decades between real interest rates and gold prices. And now, again, put it all back together, that's why I think we should expect, though it's going to be a bumpy ride, maybe another 20% in gold at some point by the end of the year.
Wow.
And probably at least another 40 or 45 in silver.
Give me some. Oh, so just see, 20% would be 2,400 for gold.
Yeah.
Give me your ending year price for gold and silver at end of 2021.
Yeah. Hey, let's just do it this way. I mean, we got all this "don't fight the Fed" stuff, right? And a continuation of the macro conditions that made me right the last couple of years. So why wouldn't you expect it to continue this year? I mean, anything can happen. But here's 2 different other ways to get at it. In the last bull market from 2005 through 2011, that's 7 years. And even with the craziness of 2008 in between, the average annual return for gold was 20.4%.
Wow.
Okay, well, if you think we're in a bull market again, and I do, that would be an average number to shoot for. Then let me give you this. Typically, and this goes for about anything, not just gold or silver, typically when something makes a new all-time high, that gets headlines, gets people excited, and you get kind of a rush of speculation, excitement, frothiness, whatever you want to call it. A typical number that I've learned over the last 30 years, that you get an overshoot of about 10%. Okay, and then you get overbought, you get pullbacks, you get people taking profits and all that stuff, and you fall backward. As recently as last year, right, gold made a new all-time high. What had been the previous all-time high? $1,920 an ounce on September 6th, 2011. That was the old all-time high. What did we get to? 2080. That is what? That's about 9% overshoot. So if we figure the same thing happens this year, at some point again, I don't know if it's sooner rather than later, I'd like it, but it may not be. It may be more like summertime. But we get to some point again where the Fed makes these changes, institutionalizes negative real rates. We're going to get a big rush back into gold again. It's going to go back to its old all-time highs from last August of 2080. If you add 10% to that, what do you get? About 2,300. If you add 20% in your normal bull market year to where we finished the year of 1900, that's about 2,300. So that seems like a reasonable target, don't you think?
So you think gold 2,300 and silver, you said $45. That's good.
Yeah.
Well, they were up 45%, 40 something percent this year. 45, 47.
Isn't that funny, Greg? The world is, at least the PM precious metals world, is so awash in people that get excited about silver that if I put out a forecast that says maybe we get to 45, people think, why are you so bearish?
Well, no, I think that's a pretty big move.
Right.
I mean, we're at about $25 an ounce now, and I was surprised at how much Jim Rickards liked gold. I mean, he's kind of a market guy. Well, he did write a best-selling book about gold.
Right.
He also but he was really keen on silver. I was surprised.
Well,
he said, it's the best performing asset in 2020. I was like, really? He goes, yeah, the asset class was 47%. I think is what he was quote was 45. I can't remember exactly. 40 something. And I thought you're saying that silver is going to go way higher. Of course, it's so volatile. And people like you're talking about a bucking bronc. Silver is the preeminent bucking bronco. Talk about it.
And Greg, again, don't just take.
But you think silver will be 45?
Yeah. Well, and actually, don't just take my word for it. What's really odd at present is all of the investment houses and research firms that are forecasting $40 and $50 silver this year.
Wow.
Citigroup, Morgan Stanley, about the only name that's absent is J.P. Morgan, and we know why they don't want higher prices. But that's getting almost an institutional awareness. Remember that guy last year from Guggenheim who said his number one key strategic play for last year was silver. So there's a lot of folks, not just dopey old me sitting out here in the middle of nowhere saying silver's going higher this year. And it's mainly going to go higher because silver is perceived to be a commodity, right? For now, it doesn't have any monetary use, though it has obviously predates gold as a monetary metal. But for now, it doesn't. It's an industrial metal. It's a commodity. And there are all kinds of folks out there that think we've just begun a new general commodity bull market. Look what's happened in the back half of last year in things like copper. Copper's at 8-year highs. Crude oil's back up over $50. And a lot of this is due to the declining dollar. And why would the dollar continue to decline? Because it's the dirtiest shirt in the laundry of fiat currency. The Fed's going to have to monetize $4 trillion of debt. And all of these commodities are priced in dollars. So as the dollar weakens, commodities go up. So that's how a lot of that fits together. And, and to double back before I forget, Rickards has always talked about remonetization of gold or a revaluation of gold somewhere up near, $10,000 an ounce or whatever. I don't want to speak for him.
He said 15. He said 15.
Okay.
He's raised it up. He said, and I think Listen, I like Rickardson. I'm not calling him a liar or anything like that, but I think he's very conservative. He's just a 5-time. He's probably by now a 6-time best-selling author.
Sure.
But he likes gold. It's going much higher. Same thing with silver. Silver's going much higher. He said 3 figures, and he said like $100. But 3 figures is a lot of. There's a lot of runway there. It's 100, 2, 3, 4, 5. I mean, there's a lot of runway at whatever. But he doesn't want to look, like he's making these outlandish like you. He doesn't want to predict the end of the world. But he was like off camera. It's going much higher. They're going up, like you.
And
I mean, you're a good company. This is not a dumbass.
Well,
This is a good guy. He's a smart guy.
and he's been expecting kind of a remonetization of gold for years. Okay, where it's currently valued at $42 an ounce or whatever it is, that the central banks will actually have to use it to make the currency sound again, to get people confident in the currency again at the end of this cycle, whenever that comes. So he comes up with that number. I'm going to kind of go off of that in the short term, and again go back to don't fight the Fed, because again in Powell's speech at Jackson Hole, he mentioned specifically that one of his big concerns is disinflationary reaction in the market. Okay, deflation. The markets collapse because the economy, the money supply is collapsing, and interest rates are spiking, all this stuff. That's what they're fighting. And he discussed Japan, how Japan's been doing this for 30 years. And the problem is disinflationary expectations then lead to disinflation or deflation, which leads to more expectations, which leads, and you get in this kind of this destructive feedback loop. And if you go back and read his speech at Jackson Hole, he said they have to fight disinflationary expectations as well. Okay, so anyway, I'll put this, what I'm getting at, and again, don't fight the Fed. From where we've been in the past, where maybe the Fed did not want a higher gold price because it reflected poorly on the dollar, I think now they don't mind. Because again, if you can get gold to go to 2,300, that would fit part of the narrative that they want of looming possible inflationary expectations.
Yeah, they want it to go up.
Right. And so all of a sudden, Fed's at least not in the way. They're not maybe necessarily on our side, but the Fed and the other global central banks maybe aren't so much in the way. And so that's important too, in thinking that we've got higher prices ahead. Back to silver. I thought last year, I look at what you here. Well, let me put it this way. I look at the chart. Gold is in uncharted territory because it's moving, off the chart upward. So you kind of have to guess and think about, this 20% number like I laid out a few minutes ago. Yep. Silver, though, still has a chart, right? It got to almost $50 back there in 2011. So we can look at that as a guide. And as I look at that, I think, okay, silver starts breaking out above the highs that we made it last year in August. That's going to get a lot of attention because it'll be trading with a number that begins with a 3. The next resistance is up around 34, 35. So we go there first. And then, like all markets, you kind of pull back and consolidate. Then from there, we start talking 40, 42, maybe 44. Now, I don't know if we finish the year there, but I certainly think those numbers are in play as we go through the year. And that has massive implications. One, first, for people that just want to buy silver, right, at an economical price and hold it as an investment, in a hedge against all this craziness. But it also impacts companies that mine silver and what they can sell their product for, and thus their earnings per share and that kind of thing. So there's a lot of significant implications of these higher prices as we go through the year. And again, that's all part of why people need to be paying attention to this stuff and how they can profit from it and benefit from it.
I mean, if you're buying gold, you're like, wow, I'm really close to the all-time high. If you're buying silver, you're like, well, I know it was up 40-something% last year in 2020, but it's half its all-time high. Is that a better deal, or is that? I mean, I know it's going to be a buck and bronc, as you've so accurately and aptly pointed out. But is that a better deal? Is silver a better deal than gold at $25 an ounce? Is it a safer deal? I don't know.
I'm not sure how to answer that, because I think most people kind of buy it off their personal preference. I mean, I own more gold than I own silver because gold is. I've always had a higher percentage of gold than physical silver because I'm trying to use gold as a.
Wait. I have to ask you a question. A higher percentage of ounces or a higher percentage of worth?
Dollar value.
Oh, dollar value. Okay.
Yeah.
All right. So you might have 1,000 ounces of silver and you might have 20 ounces of gold.
That kind of thing.
Okay.
Yeah.
All right.
Okay.
All
And
right.
I do that because I see gold, because eventually I know it's going to be remonetized. That's how it's always worked in the past. You start out, I mean, this goes back centuries. You start out with your system, your monetary system anchored to something sound like gold. I mean, they go back to the Roman Empire and you can see this. Then eventually, as your empire expands and you need to devalue your currency, you start shaving those coins off or
Yeah.
whatever, just completely go off the gold standards we did in 1971. And all of this eventually ends with a complete lack of total destruction of confidence in your paper currency, and you get the wheelbarrows full of cash that you've seen in Weimar Germany or Venezuela. Okay, obviously we're not there yet, but that's how it all ends. And then the pendulum swings all the way back to the other side, and you get back to sound money. So I figure gold, physical gold, is my boat in the storm. Okay, silver though is a great speculation, I think, just because I understand the dynamics of the market and how unbelievably poorly it's priced and how it is, I guess we'll call it mispriced based off of the trading of all these derivatives and
It's cheap.
unallocated. Yeah, so I think there's great potential to just simply make more fiat cash in silver. But as a harbor in the tempest, if you will, that's how I use gold, and that's why I have more gold than silver. But going through this year, think of silver as a commodity, as an industrial metal, fantastic conductor of electricity, needed for all these solar panels and batteries and everything else, all the Green New Deal stuff that they want to do here in the US and globally. It also has always been linked inversely with the dollar. So if the dollar falling, things could really move quickly in silver again. And so that's why, a $40 price target may be conservative. I mean, if things really catch fire, but I think certainly it's backed up by fundamental rationale of what's going on in the big picture.
Craig Hemke, excellent analysis. Silver, Sinclair said this on one of the interviews. He says, silver's going to do, on a percentage basis, it's going to go up much higher than gold. But to your point, it's going to be a bucking bronco. Most people can't hang on to the horse
Right.
or the bull. They
Right.
can't hang on to it. They can't make it. They can't hold their trade. They can't buy it at 25 and go. It went down to 20. At $20. A Bitcoin. I mean, Bitcoin. You talk about a bucking bronco. I mean, it was 40 something for and down to 34, and I look at that and go, man, it's Bitcoin. I mean, it's all over. I don't have it. I don't sell anything gold, silver, Bitcoin, nothing. But I just look at it as a marker for all this cash going somewhere, and a lot of it's finding its way in Bitcoin. But like Bitcoin, a lot of houses are buying Bitcoin. A lot of investment firms, like you said, brought up that hey, listen, last year that wasn't just some obscure trade. Big trading houses are buying gold and silver, and they had a pretty good move last year.
Yeah. And for all the same fundamental rationale I've been laying out, the key one again being that negative real interest rates. That is historically the best correlation, the biggest driver, because it makes gold. Why wouldn't you own gold? Again, if you have negative nominal rates, which you see now $18 trillion worth of negative yielding bonds around the world, and if you have, say you're a saver in Germany, where they're charging you money to hold your money in a bank, or you own a bond that has a negative yield on it. Why wouldn't you own gold instead? Yeah, well, gold doesn't pay a dividend. Well, that beats the pants off of negative 1%. And then you get the upside potential rather than just simply get your, devalued dollars back when the thing matures. And so it's a natural competition, and that's why it's such a key driver for gold. Again, man, that notion of the bucking bronco or the bucking bull, I just think it, as a metaphor, it fits because it's going to try to kick you off, but you got to ride it to the bell to win. I have a lot of people on my side. I mean, I've been doing this for a decade now that still I get notices from them, either in the comment section of the threads or by email saying, thank you. You're the only thing that kept me holding the metals in 2014 and 15 and 16 was because you kept saying, keep your eye on the big picture, keep your eye on the big picture. These are just days, these are just weeks. You got to focus on the big picture. The math is the math. So I still get people thanking me that. Now I'm sure as we go through this year, I'll get a lot more of those emails. Because, if I could just, Greg, if I could just Rip Van Winkle this whole thing and just shut off my computer and open it back up on Thanksgiving, that'd probably be easier because the intraday stuff is always going to be very challenging, even more so this year. But I'm confident that we've got this pretty well figured out as to ultimately what the price trend is.
In past interviews, you've given a promo code. It's half off your price for your
Oh yeah.
TF Metals report, your community. This article called, hold on, the 2021 A Gold Odyssey, free on your site. It's free. You
Yeah.
don't have to buy anything. I'll put the link up there. Also to your half off 50% promo code. What was it? Is it Hunter or USA Watchdog?
Yeah. Yeah.
It's Hunter.
Yeah. It's fun.
No, it was the same as last time.
Yeah. A lot of
Okay.
your.
I'll put that link up there too.
A lot of your viewers have taken advantage of this in the past, and I just want my site's not expensive in the first place. It's $15 a month, so 50 cents a day. I try not to price people out because I think it's so important, whether it's hand holding or giving you forecasting and giving you courage to hang in there, all that kind of stuff, reassurance that the math is the math. I think it's important that you get that message, and maybe that's the main value. But I also I post analysis every morning. I post a podcast every afternoon. And the community is fantastic as well, the community of members.
You're working your tail off.
Well, yeah, it's yeah.
Yeah, when we started this interview, I said, the 10-year I said, oh, you already know that. Yeah, I do. It's at 1.15%. I said, you already know that. Yeah, I know it.
And it is exhausting. I mean, it's not like I'm out digging ditches and breaking rocks, right?
No, but it's a lot of, listen, people think this is easy. Well, the easier it looks, the harder it is. So I know you make it look really, really easy. And so I know you work hard. But I'll put the links up. The TF Metals Report website is going to be up, tfmetalsreport.com. Your promo code. This article's on the front page of TF Metals Report. You don't have to buy anything. Craig Hemke, thanks for coming on and giving us your forecast for gold and silver and the markets 2021. Thank you so much for joining us today on USAWatchdog.com.
No problem, Greg. And Greg, just one last thing, just to be clear. If you subscribe to TF Metals Report, you go through the process, click a username, you open an account, you pick a username, you pick a monthly subscription, not annual, a monthly subscription, and you enter the coupon code, just the word Hunter at checkout, and you get 50% off your first month. So it'll save you $7.50, but hopefully that's an incentive to give us a try.
And I've gotten zero complaints about you. When people want to get out, you just let them out. So thank you. That's very kind of you. They're very, very nice. Craig Hemke, again, thanks for joining us today on USAWatchdog.com.
My pleasure, Greg. Always great to see you.